You're not in the middle.
For Wall Street Media, I'm Cynthia. I'm here with Doug, and we'll help you make money in the stock market with information you will not find anywhere else. And we can guarantee you that. Doug, what do you have for us today?
Exclusive stuff. Rich Gordon, Wachovia Securities, fixed income strategist. Only we have it.
Your favorite person of all time, Rich Gordon, because Rich Gordon. I just called him Rich Gordon.
Hey, do you know what?
Rich Gordon, because he's super smart.
You got Rich right. There's the look.
He's got the perfect name, doesn't he?
Yes, he does.
Does he ever use that?
Rich? No, he's very professional and a gentleman and polished.
Well, let's get into what we're going to show.
Perfect timing.
Rich
Listen,
Gordon,
fixed income strategist, super smart guy with oodles and oodles of integrity and brains, and he's talking about it. And the Fed's going to be out at 2:15 today with their latest cuts, and we've got Rich right ahead of that.
All right. Well, that was the intro.
No, you do it.
You want me to do it?
Yeah.
All right. Anyway, we've got Rich Gordon, fixed income market strategist for Wachovia Securities, discuss the interest rate portfolio positioning, a slight improvement in the credit markets, as well as the AAA sectors. So that's good. And I think these rate cuts are good.
So do I.
I do think they're good. So let's hear about it.
Today, I'd like to spend some time discussing interest rate portfolio positioning, which from a strategic standpoint, I think needs to be underweighted to duration. There's less of a flight to quality bid for treasuries because of the Fed's aggressive intervention after the Bear Stearns acquisition. At the same time, commodities prices have increased by 9% since the beginning of April, and that has revived some inflation concerns. This week's Fed meeting may result in the final ease in this cycle, so the curve has reacted by bear flattening. It's a response that's very typical at the end of monetary easing cycles. This bear flattening trend will probably be with us throughout 2008. Portfolio managers that haven't done so already should generally shorten duration positions across each duration bucket. In this type of environment, it becomes very difficult to make money on the long side of the market. And that means it's hard to significantly enhance portfolio performance trading rates because underweighted or short duration positions usually have negative carry. I think this is why there's been such a strong flow of investment dollars into the spread sectors over the past 4 weeks. They were very cheap after months of severe underperformance. But more importantly, those depressed spread sectors clearly represented the best risk-return performance profile in the fixed income markets during the rest of 2008. Over the past several weeks, we've discussed the potential vulnerability of long treasuries. A weekly price chart shows that at Friday's close, the 10-year broke a key support line that has held since early July. Given the upward pricing pressures from commodities and the expected positive economic impact in the third quarter of tax rebates that are starting to get mailed now, further weakness in long treasury prices seems likely. In order to prevent the liquidity and credit contraction we've had from turning into an economic downturn of equal or greater severity, the Fed has taken on most of the responsibility for stabilizing the markets. In addition to 300 basis points of target rate cuts, the Fed's injected over $200 billion of additional liquidity into the financial system through repo. In the process, the Fed has shrunk its reserve holdings of government securities by over 30%. It's disturbing that after all that intervention, the TED spread is still very wide, almost matching the widest levels of this liquidity and credit crisis. Credit risk evaluation is playing a much bigger role in setting LIBOR rates now than a year ago. For me, it all suggests that in order to convincingly get this market back to a real and sustainable recovery, other central banks in the world, like the ECB, are going to need to shoulder more of the burden. Turning now to the credit markets, the tone has significantly improved over the past month, and we're seeing a number of positive signs right now. First, a massive tightening in synthetic IG spreads and an apparent turn for the better in investment-grade cash spreads. The cost of buying protection on the on-the-run synthetic index has dropped by 50% since the peak level reached on March 14th. A lot of this tightening is short covering, but it's notable that the correlation markets are trading rationally. This suggests a generally liquid, orderly synthetic market. And while we've made the point that synthetic spreads are a poor market value hedge because they're largely uncorrelated to cash spreads over short horizons, the general direction of spreads there might end up being a leading indicator for better investor sentiment and demand for cash securities going forward. Second, we've seen heavy issuance in investment grade space over the past 4 weeks. The large new issue discounts that were required to get deals done in February and March have narrowed a lot. This is a positive. Those huge OIDs had been putting constant pressure on secondary spreads. Third, dealer inventories are light. The chart shows that inventory levels have dropped significantly. From an investor's perspective, this is important because the dealer community is a key source of potential liquidity, and if they're full up, they simply can't provide as much of their balance sheet to investors. Finally, in structured products, the sanctity of par has brought some liquidity back to the AAA sectors. One of the laws of bond math is that unless there are defaults, almost all fixed income securities eventually return par back to the owner. This is why bonds that have had their prices battered for reasons other than credit losses can be highly convex. If an investor buys at a discount and the security matures at par, the accretion significantly augments the current yield from the coupon payment. That's especially true for callable bonds or structures that benefit from a favorable waterfall. Real money indexed investors like to buy cheap sources of convexity, and this is a good way to do it. I think this explains why AAA structured spreads have turned the corner and begun to tighten. Credit cards, autos, as well as residential ABS all look like they've seen their wides. CMBS spreads at the top of the capital structure have been steadily tightening for most of the past month. But the CLO space hasn't really participated in this same turn. The only real customer interest we're seeing in CLOs is in the bottom part of the capital structure. Here, the disconnect is mostly because of financing. For leveraged investors, financing rates help drive portfolio decisions. And with financing still unfavorable for most structures, they can only achieve their target levels for returns in the tranches with the highest unleveraged yields, which is at the bottom of the capital structure. Thanks for joining us.